In Chapter 20, we talk about CVP analysis or cost volume profit analysis. This is an analysis that companies use to determine what they need to break even and make other business decisions. In our first example, we're looking at a company that has a contribution margin ratio of 25%. We have current fixed costs of $80,000. Our sales revenues are forecast to be $1.2 million for the year, and we're considering making an additional $20,000 expense. We have two options. One is to start a new ad campaign that can increase our sales revenues by 5%. The other one is to license a new computerized ordering system that is expected to increase the contribution margin ratio to 30%. So we need to decide which option is the best option for our $20,000 expense. First, we're going to look at what is our projected operating income without either investment. So operating income is sales minus variable costs minus fixed costs. So we haven't been given our variable costs, but we have been given our contribution margin ratio, which contribution margin is sales minus variable costs. So we're going to take our $1.2 million in sales times 0.25 or 25% and subtract 80,000 in fixed costs. And that is the formula for our sales or operating income. So our operating income without either investment is predicted to be $220,000. Now we have that we can either have the ad campaign or the new computer system. Our projected sales revenues with the ad campaign is an increase of 5% over what we're currently making. Well, our current projection is 1.2 million. So we want to take that 1.2 million times 1.05 or 105% to get a 5% increase. Our new sales are projected to be 1,260,000. Our contribution margin stays the same at 25%. So we would take our sales times our contribution margin, and we get total contribution margin of 315,000. That is what our sales minus our variable costs would equal. We then have our fixed costs. So our new fixed costs are $100,000 because we've added a 20,000 expense. Our new operating income with the ad campaign is 215,000. So if we spent an additional 20,000 on advertising, we would actually reduce our operating income by $5,000. Let's look at the computer system. With the computer system, we have the same sales. Our sales aren't going to change at all, but our contribution margin is going to increase from 25% to 30%. So we take sales times our contribution margin ratio, we get 360,000. We subtract our new fixed cost of $100,000, and we have new operating income of $260,000. Our operating income, therefore, would increase by $40,000 with a $20,000 investment in this computer system. So that makes the computer system seem like a great idea. The second part of this problem says, by what percentage would sales revenue need to increase to make the ad campaign as attractive as the computer system? So we need to know how high do our sales need to be in order to make the operating income of $260,000, just like we have in the computer system. So we take our contribution margin of $360,000, and in order to predict what our sales would be, we divide that by our 25% contribution margin ratio. Which gives us sales of $1,440,000. Our current sales are $12 million. So if we take 1,440,000 minus 1.2 million and divide it by 1.2 million, we are told that we need an increase in 20% in sales to make the advertising campaign give us an operating income of $260,000. So instead of the 5% increase that is predicted, we would need it to be a 20% increase. Our next example looks at CVP analysis. So remember, in CVP analysis, we can look at the break even, the variable cost, the fixed cost. We're trying to decide how many units we need to break even, how much we can make with different amount of sales. So it gives us some information. It tells us that we sell pens for $1.75 each. Then it tells us that we have a break-even point of 40,000 units. And at 40,000 units, our total variable costs are $50,000. And our total fixed costs are $20,000. So our first question says, what is our contribution margin per unit? Well, contribution margin is unit sales price minus unit variable cost. Our unit sales price is $1.75. That is given to us. Our unit variable cost we have to calculate. And what it tells us is that we have total $50,000 in total variable costs at production of 40,000 units. So if we take $50,000 divided by 40,000 units, we get a unit variable cost of $1.25 per unit. Our unit contribution margin is $1.75 sales price minus $1.25 in sales cost, or 50 cents per unit. Part B says, what is our margin of safety at sales of 45,000 units? Our sales revenue at 45,000 units would be 45,000 times our sales price of $1.75 per unit. And our sales revenue at break even is 40,000 units. So we would take 40,000 times $1.75 sales price. Or 70,000. Because margin of safety is the difference between our projected sales revenue and our break-even sales revenue. So our projected sales revenue, if we sell 45,000 units, is $78,750. Our sales revenue at break even is 70,000 because it told us that our break even point was 40,000 units. So our margin of safety is sales revenue, projected sales revenue minus break even sales revenue, or $8,750. Part C wants to know what is our estimated operating loss at sales of 38,000 units. So our sales revenue at 38,000 units is 38,000 times $1.75 sales price each. Then we have our variable costs at 38,000 units equals 38,000 times variable cost of $1.25 per unit. And our fixed costs are $20,000. So our total costs $47,500 plus $20,000 equals $67,500. So our loss is our sales revenue minus costs. So we would have a $1,000 loss at 38,000 units. D wants to know what is our unit cost at production level of 40,000 units. So we already know that. Our variable cost at 40,000 units, we already calculated, is $1.25 per unit. And our fixed cost is 50 cents per unit. So our total cost at production of 40,000 units is $1.75. That's our break-even cost. As we increase production, our variable cost per unit stays the same, but our fixed cost per unit decreases because we have more units to spread our total fixed costs over. So our variable cost per unit stays the same at $1.25 per unit. But now our total fixed cost of $20,000 gets spread across 50,000 units instead of 40,000 units. So our total fixed cost per unit is now 40 cents per unit. And our total cost per unit at a production of 50,000 units is $1.65.